When we talk about insurance, one question matters more than any other. Can this insurer comfortably pay claims when they arise? That is exactly what the claims coverage ratio helps us answer. In today's episode of our Financial Ratios series on Insurance World TV, we break down the claims coverage ratio, what it means, why it matters, where to get the data, how to calculate it, and how to interpret the results to make informed decisions. Before we begin, take a second, subscribe to our channel. As always, we'll break claims coverage ratio down by answering a few critical questions that will help you see how it works in practice, why it matters, and how it can be used to make informed decisions. Let's dive in. Question 1. What is claims coverage ratio? The claims coverage ratio is a financial metric used to assess an insurance company's ability to pay claims using its available financial resources. In simple terms, it answers one critical question. If many claims arise today, does this insurer have enough assets to pay them? What the claims coverage ratio measures. Unlike the claims ratio, which compares claims to premiums, the claims coverage ratio compares assets to claims obligations. It focuses on financial strength, liquidity, and solvency, not underwriting performance. Simple definition. The claims coverage ratio measures how well an insurer's available assets cover its expected or outstanding claims liabilities. Typical formula. While formulas can vary slightly by analysis purpose, a common approach is claims coverage ratio equals admissible assets divided by outstanding claims liabilities, where admissible assets are regulator-approved assets that can be relied upon to pay claims. Outstanding claims liabilities include reported claims, incurred but not reported claims, and claims provisions. Question 2. What is the difference between claims ratio and claims coverage ratio? The claims ratio and the claims coverage ratio serve very different but complementary purposes in assessing an insurer. The claims ratio compares claims to premiums and focuses on underwriting performance, showing how much of the premium income is being consumed by claims, making it most useful for actuaries and underwriters in pricing and risk selection. A high claims ratio signals high claims cost and pressure on profitability. In contrast, the claims coverage ratio compares assets to claims obligations and focuses on financial strength, liquidity, and solvency, making it especially important for regulators, corporate clients, and procuring entities. Here, a high ratio is positive as it indicates strong claims-paying ability. In short, the claims ratio asks, is the insurer pricing risk correctly? While the claims coverage ratio asks, can the insurer actually pay claims when they fall due? The claims ratio tells you how expensive claims are. The claims coverage ratio tells you whether the insurer can actually pay those claims. Question 3. Why does the claims coverage ratio matter? This ratio matters because insurance is a promise to pay, not just a contract to collect premiums. Here's why it is critical to financial stability. For policyholders and corporate clients, it shows whether an insurer can pay large or unexpected claims, helps avoid insurers that look profitable on paper but are cash-strained, and builds confidence in long-term claims settlement ability. For regulators, it highlights insurers that may be technically solvent but practically stressed, supports early intervention and closer supervision. For insurers, it guides capital management, informs reinsurance decisions, and protects reputation and market trust. An insurer with weak claims coverage may delay payments, dispute claims excessively, or depend heavily on reinsurance recoveries, all red flags. A strong claims coverage ratio indicates that the insurer can meet claim obligations even in high loss periods, policyholders are protected, and large or catastrophic claims are less likely to strain the company. A weak ratio signals liquidity stress, higher risk of delayed or unpaid claims, and possible need regulatory intervention. This ratio is used by regulators to monitor solvency and policyholder protection. It is also used by corporate clients and procuring entities to assess insurer reliability. Lastly, it is used by risk managers and auditors to evaluate financial resilience. It is one of the most important indicators of claims paying ability and financial strength in the insurance industry. Question 4. Where can one get data to calculate claims coverage ratio? You do not need insider access to calculate this ratio. Reliable data sources include: Number 1. Insurance company annual financial statements. Number 2. Insurance regulatory authority reports available on their website. Number 3. Audited annual reports of listed insurers available on company websites and Nairobi Securities Exchange portal. In these reports, look for outstanding claims reserves, claims provisions, technical provisions, and total admissible assets. Key tip: always use net figures, meaning after reinsurance, after admissibility adjustments. This ensures accurate and fair comparison. Question 5. How is claims coverage ratio calculated? Let's make this practical and simple. Basic formula, common approach. Claims coverage ratio equals available claims paying resources divided by outstanding claims obligations. Depending on the insurer, available resources may include technical reserves, liquid assets, and admissible assets backing claims. Illustration. Let's assume that net outstanding claims is 1.5 billion Kenya shillings. Admissible assets backing claims is 2.1 billion Kenya shillings. Then claims coverage ratio is calculated as follows. 2.1 billion divided by 1.5 billion gives you a result of 1.4, meaning that assets exceed claims by 1.4 times. To turn it into a percentage, multiply by 100% and you will get 140%. This means the insurer has 140% coverage of its claims obligations. No complex accounting, just sound financial logic. Question 6. How is claims coverage ratio interpreted? Figures alone does not make sense. For claims ratio to be useful, it must be interpreted correctly. This is where insight really comes in.
Here are some insights.
Number 1. If the claims coverage ratio is below 1.0 or below 100%, it means that the insurer's claims obligations exceed its available financial resources. This is a red flag, indicating a high risk of delayed or unpaid claims. Such a position raises serious financial stability concerns and is likely to attract regulatory scrutiny or intervention, as it suggests the insurer may struggle to meet its claims-paying obligations. Number 2. If the claims coverage ratio is between 1.0 and 1.2, it indicates an adequate but tight financial position. The insurer is generally able to pay claims, but with limited safety margin. This means the company is vulnerable to shocks, such as unexpectedly large claims, adverse loss experience, or market volatility. While not immediately concerning, it calls for careful risk management, strong reinsurance support, and close monitoring to maintain stability. Number 3. If claims coverage ratio is between 1.3 and 1.5, it indicates a strong position. The insurer demonstrates a comfortable claims-paying ability with a healthy buffer above its claims obligations. This range reflects a good balance between financial prudence and capital efficiency, giving confidence that the company can absorb moderate shocks without straining its resources. Number 4. If claims coverage ratio is above 1.5, it indicates a very strong position. This indicates an excellent financial cushion. The insurer holds significantly more resources than required to meet claims, offering high confidence in its ability to settle large, complex, or unexpected claims. Such a ratio is particularly reassuring for corporate clients, large risks, and long-term partnerships. Question 6. How is claims coverage ratio used to make informed decisions? Here is how each group can apply claims coverage ratio to make decisions that are useful to their line of work. Number 1. Corporate buyers and procuring entities. For corporate buyers, price alone should never be the deciding factor. A strong claims coverage ratio is far more important than a low premium. This ratio gives insight into whether an insurer has the financial capacity to honor claims when they arise, especially large, complex, or unexpected claims. This is particularly critical for high-exposure lines such as engineering risks, medical schemes, group life policies, and public sector covers, where delayed or unpaid claims can disrupt operations, affect employees, or expose the buyer to reputational and financial risk. In short, a well-capitalized insurer offers peace of mind and long-term reliability, not just short-term cost savings. Number 2. Regulators. For regulators, the claims coverage ratio is an early warning indicator. It helps identify insurers that may be financially stretched and in need of capital strengthening or closer supervision. By monitoring this ratio, regulators can intervene early, before claims go unpaid or policyholders are affected. This proactive oversight is essential in protecting policyholders, maintaining market stability, and preventing sudden insurer failures that could undermine confidence in the insurance sector. Number 3. Insurers. For insurers themselves, the claims coverage ratio highlights the importance of financial discipline and balance. A strong ratio encourages insurers to build adequate reserves, improve the quality and liquidity of their assets, and align underwriting decisions with their true capital strength. It discourages aggressive growth that is not supported by capital and promotes sustainable underwriting, sound investment strategies, and long-term resilience. Ultimately, maintaining a healthy claims coverage ratio strengthens trust with clients, regulators, and the broader market. The claims coverage ratio goes beyond profitability. It answers the most important question in insurance. When claims happen, is the insurer truly ready? That marks the end of our lesson today. In our next episode, we continue this series by exploring another critical ratio that every policyholder and risk manager should understand. If you found this useful, please like the video and share it with your procurement or finance team. Meanwhile, subscribe to Insurance World TV for practical insurance insights that protect your decisions. Until next time, stay informed and stay covered.